Good morning. For Traders Exclusive, this is George Tkaczuk, we're RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. What I'd like to do is talk about the equity markets, and as the equity markets continue to rally, what I'd like to do is dispel a few myths. A lot of stories in financial presses that we've come too far, too fast, we're going too high, it's a sugar highs, isn't sustainable. Let's back up a little bit. Yes, the market did bottom in 2009. However, we had a bear market in 2011. Some people aren't calling it a bear market because we didn't close it down 20%. The S&P, it was 19-something percent. That's okay. It was a terrible time to try to make some money at second half, 2011 being long. Furthermore, in 2015-16, we had another bear market. Now the S&P didn't go down 20% again, but various sectors were rotating through that part where we had financials down 30 or 50%. Same with biotechs were down, and different sectors kept rotating, getting killed. And the indexes moved sideways, but underneath the hood, it was a terrible bear market. And then furthermore, at the back end of 2018, that last quarter, total meltdown in the equities. And that was, I'm going to call that a bear market because again, the market just scared the pants out of everybody. And of course, this year it rallied. So the point is that we've come too far too fast. It's not true. We've had 3 resets in that period since 2009. Furthermore, we've basically been moving sideways. If you look at the chart on NASDAQ S&P for about 21 months. We haven't really made any great progress. So not until the S&P got a little over that 3,000 level, 3,020, did we start this new up leg. And then the idea is you need to keep an open mind, anything's possible. And underneath the hood, everything's looking very good, meaning we had semiconductors doing very well. And now we have biotechs doing really well. I talked about all these things over the last few weeks. We had software sector corrected heavily that led earlier this year, and now a lot of those stocks are building the right side of their bases. We're seeing breakouts in stocks like Paylocity, Paycom, Microsoft still leading the market. Adobe Software is building the right side of his base. Coupa Software is doing well. So you got a lot of choices, a lot of different things to look at, and they're all doing well. Home builders are doing very well. That's not a market that's in a late stage. That's a market that's everything's starting to come together. We're still waiting for the small caps to kick in, but the point is, this is a possible new up leg. You need to keep an open mind, but as always, let price and volume be your guide. Now, let's say the S&P were to back up, fall, crash below 3,000, let's say, or then take out the October lows, then I'm willing to say, okay, everything I've told you just now is for naught. However, it's highly unlikely that we'll reach test the December lows. It's of course to be seen. That's why I always say let price and volume be your guide. So as long as prices are moving your way in your positions or in the indexes you're holding, stay with the rally. But as always, let price and volume be your guide. This is George Tkaczuk, we're RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Have a great trading week and stay with that rally.